Welcome to Outside the Dollar. I'm glad you're here today because we have a lot of ground to cover. Here's what's on the table. The Federal Reserve held rates steady this week, but CNBC is reporting the internal disagreement was the sharpest we've seen since 1992. That kind of division inside the Fed tells us something important about where policymakers think we're headed. And the economic picture they're staring at isn't simple. A CNBC survey found 81% of respondents believe higher oil prices will likely push core inflation higher. At the same time, Dalio has a clear warning out there. Cutting rates into a stagflation environment could seriously damage confidence in the central bank. So what does any of this mean if you're 5 years from retirement or already in it? That's exactly what we're going to work through today. We'll look at how inflation quietly erodes purchasing power, even when your account balance looks fine. We'll examine gold's role as a store of value, including an honest look at the recent pullback and what institutional analysts are projecting. And we'll close with a practical question every retirement saver should be asking about their portfolio right now. The important thing to understand is that these macro forces connect directly to your savings. Let's get into it. Here's a question worth sitting with for a moment. Is your retirement savings actually keeping up with the cost of living? Not on paper, in real terms. That gap between what your account says and what your money can actually buy is exactly what we're digging into today on Outside the Dollar. 3 stories landed this week that, when you put them side by side, paint a pretty clear picture of where the economy is right now, and none of them are comfortable reading. Start with this. CNBC published survey results showing that 81% of respondents expect higher oil prices to push core inflation higher. That's not a fringe view. That's an overwhelming consensus from the people the survey reached. And when oil prices rise, the effect doesn't stay at the gas pump. Energy costs move through supply chains, trucking, manufacturing, food distribution. Prices climb on things that have nothing obvious to do with oil at all. So we're looking at a scenario where inflation pressure has more fuel behind it at the exact moment growth is expected to slow. That combination has a name: stagflation, rising prices and slowing growth happening at the same time. It's the economic situation policymakers dread most because the usual tools pull against each other. Which brings us to the Fed. On Wednesday, the Federal Open Market Committee voted to hold its benchmark rate steady in a range between 3.5 and 3.75%. According to CNBC, this may have been Jerome Powell's final meeting as chair. Markets had priced in a near certain hold, so the decision itself wasn't the headline. The headline was the disagreement inside the room. CNBC reported this was the highest level of dissent at a Fed meeting since 1992. That tells you something. When the people inside the central bank can't agree on the path forward, it's a signal that the path forward is genuinely unclear. Cut rates and you risk letting inflation run hotter. Hold rates and you risk pressing harder on an economy that's already slowing. Neither option is clean. Dalio put it plainly on CNBC's Money Movers. The founder of Bridgewater Associates said, and I'm quoting here, "We are certainly in a stagflationary period." He went further, arguing that if Kevin Warsh, who is reportedly in line to replace Powell, were to cut rates in this environment, it would risk damaging confidence in the Fed at exactly the wrong moment. Dalio's point is that caution is the only responsible move when both inflation and slowing growth are present simultaneously. Here's why this matters beyond the economics classroom. The Fed's decisions shape borrowing costs, job markets, and the returns on the savings instruments most Americans rely on. When the Fed is stuck between 2 bad options, that pressure doesn't stay inside the Eccles building in Washington. It shows up in your grocery bill, your mortgage rate, and over time in the real value of your retirement account. Think about it this way. If your savings are growing at 4 or 5% annually, but inflation is running at a similar rate or higher, you're not actually ahead. You're running to stay in place. And for people who are 5 or 10 years from retirement, that treadmill has real consequences. So here's the question I want you to carry into what we cover next. If inflation keeps running and growth keeps slowing, what does that actually do to a retirement account over time? Not in theory, in dollars. So here's what that macro picture actually means for your savings, not in abstract terms, but in real everyday terms. Think about this. You check your retirement account and the balance looks about the same as last year. Maybe it's up a little. That feels okay, right? But here's the thing. If inflation is running faster than your returns, you are losing ground. The account balance is steady, but what that money buys is shrinking. The Lear Capital piece this week framed it simply. Rising inflation pressure alongside slowing growth is exactly the kind of environment that makes retirement savers uneasy. And they're right to be uneasy, not panicked, but paying attention. Think about the categories that actually eat up retirement budgets: food, energy, insurance, healthcare. These are not discretionary. You cannot cut them the way you can cut a vacation or a streaming subscription. And these are precisely the categories where price increases have been most stubborn. Now, the purchasing power problem hits retirees and near retirees hardest, and here's why. If you're 35 and inflation takes a bite out of your savings for 2 or 3 years, you have decades to recover. If you're 62 and watching the same erosion, your window is much shorter. The math works against you in a way that just doesn't apply when you're younger. So the question isn't just how much you have saved, it's what those savings will actually buy in the future. That distinction sounds simple, but most people don't think about retirement wealth in purchasing power terms. We think in dollar amounts. We set a number, a target, and we chase it. But $1 million in a low inflation decade is not the same asset as $1 million in a high inflation one. The CNBC survey we mentioned earlier, 81% of respondents expecting higher oil prices to push inflation higher. That's not a fringe view. That's a broad consensus among people who watch these markets closely. And if that expectation holds, the erosion of purchasing power for savers is not a hypothetical risk. It's an active one. So what do? You start by asking whether your current retirement allocation was built for this environment. A portfolio designed in a low-rate, low-inflation world may not hold up the same way now. That's not a criticism of past decisions. It's just an honest look at whether the strategy still fits the conditions. And that question, what assets actually preserve value when currencies lose ground, is one that investors have been wrestling with for a long time. Which brings us to something worth understanding closely: gold, and why it tends to come up in conversations exactly like this one. So, what assets actually hold their ground when currency loses purchasing power? That question has been answered the same way for thousands of years: gold. Now, gold isn't a perfect asset. Nothing is. But here's what the historical record shows. During inflationary periods and times of economic stress, gold has repeatedly served as a store of value when paper assets struggled. Here's where things get interesting right now. Gold has pulled back roughly 11% from its recent highs, and I want to be honest about that because some people see a pullback and assume the story is over. It isn't. Pullbacks are normal part of market cycles. Every significant gold run in modern history has included corrections like this. The question isn't whether price moves are linear, because they never are. The question is what the underlying conditions look like. Brian London, editor of Gold Newsletter, described gold and silver right now as, quote, racehorses at the starting gate. His argument is that the macro conditions driving demand haven't changed. Stagflation concerns, Fed uncertainty, slowing growth. Those forces don't disappear because the price dipped. And institutional money seems to agree. JPMorgan is projecting gold prices above $6,000. That's a projection, not a guarantee. No one rings a bell at the bottom or the top. But when major institutional analysts are publishing targets that high, it tells you something about how they're reading this environment. Silver is part of this conversation too. Citigroup has projected a move toward $150 for silver, though that figure is conditional on broader market conditions playing out as expected. Silver tends to be more volatile than gold, which means the swings in both directions are sharper. Here's the counterargument, and it's worth saying plainly. Pullbacks can extend. No one knows the exact timing of the next move. If you bought gold at the peak and needed to sell tomorrow, you'd be sitting on a loss right now. Precious metals don't pay dividends. They don't generate cash flow. The case for holding them is a macro case, built on what happens to purchasing power over time, not a short-term trading case. So you weigh that honestly. The data suggests persistent inflation pressure. The Fed is divided, growth is slowing, and gold has a long track record of preserving purchasing power in exactly that kind of environment. Which raises a practical question. If gold and silver are worth considering as part of a retirement strategy, how would someone actually hold them? Not a trading account, not a shoebox. Inside a retirement account with the same tax structure you already have. That's where the Gold IRA conversation becomes relevant, and that's exactly what we're going to walk through next. So here's the practical question. You've heard the macro picture, the Fed uncertainty, the inflation data, the case for metals. What does any of this mean for your actual retirement account? A Gold IRA is simpler than it sounds. It's a self-directed retirement account that holds physical gold or silver instead of or alongside traditional paper assets. You fund it through an IRA transfer or a 401k rollover. The metal is stored in an IRS-approved facility. That's the mechanism. The reason this matters right now comes back to everything we've walked through today. According to CNBC, 81% of survey respondents expect higher oil prices to push core inflation up. The Fed just held rates steady through its most divided vote since 1992. Ray Dalio called this a stagflationary period and warned against premature rate cuts. That combination, rising price pressure alongside slowing growth, is the exact environment that historically drives retirement savers to reassess whether paper assets alone are doing the job. And here's the thing to understand clearly. A Gold IRA isn't a replacement for your existing strategy. It's a diversification tool. The question isn't whether you should abandon stocks or bonds. The question is whether your current allocation accounts for the environment we're actually in. Lear Capital was recognized as Best Overall Gold IRA Company by Consumer Affairs in 2026 and Best Value by Yahoo Finance in 2026. Their emphasis is education first, understanding your options before making any move. So here's your takeaway for the week. Pull up your current retirement allocation. Look at it through the lens of purchasing power, not just account balance. If inflation stays elevated, does what you hold today protect what you've built? That's the question worth sitting with. That's a wrap on this one. The through line today was clear. When inflation eats into purchasing power quietly, a steady account balance can hide real losses. And if you're close to retirement, that window to recover is shorter than most people realize.